What is cost value profit analysis? CVP analysis is financial tool that show how change in sale volume, cost, fixed and variable, and pricing impact on company operating profit, helping businesses find their break-even point, set profit targets, and make informed decisions on pricing and production. It uses formulas to understand the relationship between cost, sale, and profit, focusing on how many units need to be sold to cover costs and start making money. For our scenario 4, Aroma Brews Sdn.Bhd is a beverage company specializing in bottled cold brew for the lifestyle market. In 2025, the company sold 52,500 units of their product with sale worth 1,050,000 ringgit. The company hires sales agent to market the product. Currently, the sales agents receive 50% commission on each sale.
Hi, my name is Sdn.Bhd Sufian, and today I would like to talking about the purpose of suggestion to the management of the company for the future action. And the question is, as a group of the business consultant, you want to help a group of business to consultant, and you want to help the business management to understand the usefulness of accounting information and the importance of applying CVP analysis for manager in decision making and provide solution for the future planning. First, based on the above information, you are required to analyze the situation and then make a group for prioritization and propose a suggestion to the management of the company for future action. Okay guys, so today I want to calculate and show the formula and calculation. Before that, I will tell the question. So A, sale price per unit of the product. B, total variable cost. C, variable cost per unit. And D, total fixed cost. And E, contribution margin per unit. And F, contribution margin ratio. And G, break-even point, BEP, and in unit. And H, break-even point in the amount of RM. So I will solve all these questions and show the formula and calculation for all of us, so we can more understand how to solve this question. Okay, so as you can see, the table have a sale, unit sold, selling commission, variable cost, and fees. So for sale, the amount is 52,500, and for the unit sold is 1,050,000, and for selling commission is 50%, and variable cost is 525,000, and for fees is 105,000. Okay guys, so now I will tell about how the formula to sell price per unit of product we can. So total sale is 1,005,000, and the unit sold is 525,000. So as we know, we get the price per unit of the product is RM20 per unit. So this is how we get the price of the product. So let's move on to the total B, total variable cost. So total variable cost is 525,000, and sale commission is 1,005,000, 50%. Okay, so we get the 157,500, the answer. So we will need to add the amount together, so we get 682,500. So that's the answer. Okay, so as you can see, for the total variable cost per unit, so total variable cost per unit is 682,500, and the amount we get for variable cost per unit is 52,000, 5,200, 5,000. Okay, so we can move for the question D. Question D is total fixed cost. So total fixed cost is, as you can see, 105,000, and for the feed advertising is 26,250, and for the rental is 21,000, and for administrative salary is 52,500, and for insurance is 50,750. So the amount we get is 222,000. So let's move for the question E and F. So as you can see, contribution margin per unit. So contribution per unit is selling price per unit, variable cost per unit. So this amount is, we get RM20 and RM13. So we need to minus the amount and we get the RM7. Okay, for contribution margin ratio, CM per unit is 7, so the price we selling per unit is 20, so that's for 35%. So let's move on to the questions G and H. So as we can see, the question is not too hard for us, so let's begin with the G, break-even point BEP in a unit. So the total of feed cost is 220,000, 22,000 and 550, and the CM unit. So CM is the short form for the contribution margin. So contribution margin unit is 7. So the total we get is 61,500. So for the H question is break even point BEP in the amount. So the amount is the RM 31,500 and the selling price is RM 20. So the amount we get is 660,000. So this amount we get from the question break even point or BEP. So that is the amount we get. So
Assalamualaikum. My name is Rawdatu Anani binti Rosli. My number matric is 310514. So today I will explain how the company calculate the number of units need to achieve a 30% net income to sale ratio in 2025. So I will start the question number 2 is identify the units of the product that need to be sold by the company in order to obtain a net income to sale ratio of 30% in 2025. So describe possible action that should be taken by the company to achieve the target. So first, the company set a target net income. The target is 30% of total sale. The total sale RM 1,050,000. When we calculate 30% of RM 1,050,000, the target net income is RM 350,000. So this means the company aim to earn RM 350,000 as profit. So we move the next part is we calculate the required contribution margin. Contribution margin for formula for contribution margin is fixed cost plus target profit. The fixed cost is RM 220,500. When we add the target net income of RM 350,000 to the fixed cost, the required contribution margin become RM 535,500. So after that, we calculate the number of units that must be sold. The contribution margin per unit is RM7. So by dividing RM 535,500 by RM7, we find that the company need to sell 76,500 units. For me, in calculation, to achieve a 30% net income to sale ratio in 2025, the company must sell 76,500 units. So we reach the target. The company can increase sales through marketing and promotions, control cost effectively, and improve efficiency to increase contribution margin per unit. That's all. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Dalilah binti Abdul Rahman. My matric number is 310541. Okay, I will explain about third question. The question is, if the company is not able to increase the number of unit sale, advise the company on the selling price that needs to be charged for the firm to earn operating income of 13% of sales. Briefly describe the possibility that the company can increase the amount of sale by simply increasing the selling price. Okay, this question explains how a company can achieve an operating income of 30% of sales when the number of units sold cannot be increased. Okay, the company sells 52,500 units. The variable cost is 13 ringgit per unit and fixed costs are 220,500 ringgit. Since the number of units cannot increase, the company must increase the selling price to earn more profit. The target profit is 30% of sales and the new selling price is called P. Using the contribution margin method, the equation is 52,500 multiplied by P minus 13 equals 220,500 plus 30% of 52,500 multiplied by P. After solving the equation, the new selling price is 24 ringgit and 57 cent per unit. This means the price increased from 20 ringgit to 24 ringgit and 57 cent, which is about 23%. This strategy can achieve the profit target, but it may reduce demand if customers are sensitive to price change.
If the company plans to improve the quality of the product over the next year, suppose the improvement will increase the COGS variable cost to 55% per unit sale instead of at 50% at the quarantine level. Fixed advertising expense is expected to increase 3,500 ringgit. Due to an advertising company plan to boost sales, it is expected that the product improvement combined with higher advertising expenses will increase sales by 200%. So discuss whether the company has the position to proceed with the plan. So when we want to calculate the new corporation margin is want to take the 30% multiply the 350,000, so we can get the answer is 945,000. Other than that, when we want to calculate the new net income is we want to take the answer by new corporation margin minus the 224,000 ringgit, so we can get the answer is 721,000. So the conclusion is the plan is finally verbal delivery, a significant profit increase, and demonstrated that higher quality combined with advertising success boosts sales.
Hello everyone, my name is Suren son of Raja and my metric number is 310498. Now I want to explain question 5 and 6. Question 5, the company is faced with its sales agents requesting an increase in the sales commission rate to 25% for the upcoming year. As a result, the company's CEO decided to investigate the possibility of hiring its own sales staff to replace the network of sales agents. The company will have to hire 6 sales agents to cover the current market area, and the fixed salary cost of each employee will average 875 ringgit Malaysia per month. In addition to their fixed salary, the 6 sales agents will each earn commissions at the rate of 5% on all sales. Advise the company whether or not to approve the agent's request. Justify your answer. Okay, question 5 is about sales agent request commission increase to 20% versus hiring own sales staff. And then we compare current proposal 20%, which is 20% commission, with new in-house sales staff plan and the given data, sales, current commission, and proposed commission. For sales, 1,050,000 ringgit Malaysia, and current commission 50%, and proposed commission is 20%. For next slide, option A is about approved 20% sales commission, and then the calculation is 20% multiplied with 1,050,000 ringgit Malaysia, and we got 210,000 ringgit Malaysia. It's sales commission, and the impact is selling cost increases significantly and not fixed salary, but very high variable cost. For option B, it's about higher own sales staff, and we need to find fixed salary cost, and the calculation is 875 ringgit Malaysian and multiply with 12 months, and we got 10,500 ringgit Malaysia per agent. So there are 6 agents, and we need to multiply with 6, and we got 63,000 ringgit Malaysia. And then commission cost is 5% multiplied with 1,050,000 ringgit Malaysia, and we got the commission cost is 52,500 ringgit Malaysia, and total selling cost is 63,000 plus with 52,500 ringgit Malaysia, and we got 115,500 ringgit Malaysia. For next slide, there are 2 options, right? So agents at 20%, and we got total selling cost 210,000 ringgit Malaysia, and then in-house sales staff we got 115,500 ringgit Malaysian. And for cost saving, we need to do this calculation, and we got 94,500 ringgit Malaysia. For conclusion, hiring in-house sales staff is more cost efficiently, and we can save 94,500 ringgit Malaysia annually, and then we can improve our contribution margin and profitability. And the best recommendation for this question, reject the agent's request and proceed with hiring own sales staff. Question 6. Provide the management of the company with the recommendation for the best strategies to be implemented in 2025 in order to boost the company's performance and increase its competitiveness in the market. Now let's look at the question 6. It's about recommendation, and the main objective is boost company performance and increase competitiveness. And the next slide is about recommendation. First recommendation, in-house sales team, lower selling costs compared to high commission agents, and then better control over sales strategy, improve net income and contribution margin. For second recommendation, improve contribution margins, control variable costs, which is commission and COGS, negotiate with suppliers, improve production efficiency. For third recommendation is strategic pricing and marketing. We need to avoid aggressive price reductions, focus on target advertising, strengthen the premium brand positioning. For fourth recommendation is about use CVP analysis and helps in profit planning, cost control decision, and sales volume targets. And we need to support better manager decision making. For last recommendation, it's about product quality improvement, enhances customer certifications, and we need to build brand loyalty and increases long-term competitiveness so much.
In conclusion, applying CVP analysis help Aroma brief Sdn.Bhd to understand cost behavior, making informed pricing and sales decision, achieve profit targets strategically, and lastly, change competitiveness in the lifestyle beverage market.